We showed this chart a lot in February and March, and it is the emotion that we all lived through in February, this big drop in the market, and then we've tapered out here and really stayed above the, the iconic 200-day moving average. And they said it in February. They called up, they said, go to cash. And even more perverse, at Dow 25,000, they call up and say, go to cash. State the case that cash isn't the place to be.
Well, there are several major reasons why that's the case. Number one is the availability of very, very good yields. And what I mean by cash is someone literally leaving money in their bank account or in their brokerage account. So lots of short-term opportunities to make 2 to 3%, in the U.S. dollar. So that's one thing. But what you're really talking about is why they should stay invested. We did a survey of all of our clients, those that followed disciplined asset allocation and those that did not, right? That basically had concentrated positions or market timed. And we did that over the last 1 and 3 years. And the average client lost between 2 and 3% per year when they tried to time the market in any material way.
You and I know psychologically the hardest part of that type 1, type 2 construct is getting back into the market once you get out. So somebody walks in right now and they say, I missed it. I'm wrong. We're up 19%, 12 months trailing on the Dow alone. Forget about Amazon and Apple and the rest of it. How do you cajole someone to be brave and get in at Donald Trump's Dow 25,000?
Right. So I think the way you cajole somebody is actually to take a look back. And again, these are long-term investors. Private bank clients really have their wealth. They want to think about their wealth for the next 5 to 10 years. So a way to do it is to look back and say, has there been any 5-year period where you've had a negative return, doing disciplined asset allocation? And the answer is no. So you start with that as the baseline. And the second thing you have to do is take a look at the relative opportunity set. Do you know that clients who have had, let's say, 20% cash balances since 2008, how much does it cost them in their total return during that period? Exactly. It's a huge amount of money, and we show them that. And you take a look at that, and it's significant. It's about half the total rate of return that they would have gotten over that period. So all of that is historical. But suppose they're not rational. Suppose they say, we're not going to do it anyway, David. Then you take a look at the capital markets and you see what you can do from a derivative standpoint. And where, now again, vol is down now, but where vol was even a week ago, you could create structures where a client could take 5% downside risk, get exposure to 25% upside risk in a basket of stocks or indices, and then simply own that. And they give up the upside for the downside, and that's how they should do it. So that's how we
David, what's the best way to diversify your portfolio right now?
And this is, you've touched upon the thing that if I could say one thing to almost every person in it, 80% of our Citi Private Bank clients are concentrated in their home market, wherever that happens to be. And, 70% of our clients are outside of the U.S. The most important thing today is to build a truly global portfolio. Because when crises happen, let's assume that there is a recession in the U.S. or something takes place unexpectedly in Latin America, clients who have those types of portfolios are much more resilient, and we've looked at that, historically, but prospectively, we think that all of the markets are moving asynchronously right now, the U.S. being the most mature in terms of its, post-recovery and the emerging markets the least. So that is the most important thing for someone to do, and we think that that will generate both an absolute higher return and a much better experience in the markets.